Everyone, and welcome to this panel on the future of money management. I'm Ashish, and I'll be the moderator for today. We have an illustrious group of panelists here with us today, so I'll keep my own intro brief and let them have the floor. I lead fintech investments at Sequoia Capital. Sequoia is a venture capital firm, and we've been investing in India for over 15 years. We manage close to $6 billion of capital for India and Southeast Asia. Fintech and financial services are an extremely important theme for us. And today we have over 30 active portfolio companies in that sector in India alone, including Grow and Jupiter, whose founders are here with us today. With that, let's kick it off. If I could request each panelist to maybe give a quick intro about themselves. Perhaps we could start with Jitendra.
Sure, thanks, Ashish. Quick background on me. So I've been in financial services space for almost like 18 plus years. And before Jupiter, I started this company, CitrusPay, which was into online payments. I ran the company for 5 years, exited to Naspers way back in 2016. And worked with PayU as India head for their payments business and the consumer lending business. 2019 is when I started this company, Jupiter, which is focusing on how do we create a mobile-first digital banking experience for the Indian young consumers, for mainly salaried professionals. And the idea is that how do we make the banking more personalized, intuitive for these set of users? So that's where we are. Thanks, Ashish.
Thanks, Jitendra. Lalit, do you want to go next?
Hey, thanks, Ashish. Hello, everyone. I'm Lalit, CEO and co-founder of Grow. But before that, I was at IIT Bombay, 2004. We are trying to make investing simple and democratic for accessible to millions of people in India. I think that's all I would want to say. Thanks.
Would you like to go next?
Sure. Thanks, Ashish. Hi, everyone. This is Puneet Sharma here. I'm from JP Morgan, and I'm responsible for managing AI-based investment in asset development and group. So my groups create models for investing, client deepening, and other stuff, and for money management in JP Morgan. I have expertise in quantitative investing. So prior to JP Morgan, I was running the quant investment strategy group in Goldman Sachs, and prior to that, I worked in Merrill Lynch and other investment bank in US and London. So I love creating new things, and so we try to create somewhat startup culture and firm like JP Morgan. So this forum is an opportunity for me to meet simple-minded people. Thank you. Looking forward.
Thanks, Puneet. Kavitha?
Yep. Thanks, Ashish. Hi, everybody. I'm Kavitha Subramanian. Big shout out to the Alumni Association, firstly, for hosting this wonderful event. I'm IIT Bombay class of 2004. And I actually joined IIT Bombay because of Sarson Ka Tel. Basically, when I came for my counseling, the professor from IIT convinced my mother that Kharagpur mein khana na sarson ke tel mein banta hai, udhar mat bhejna. So here I am. Clearly, mom knows best decision ever. After IIT, I joined McKinsey & Company. Worked in microfinance in India's villages for a bit. Best experience. Was a private equity investor before being a co-founder of Upstocks. We're India's leading digital investing platform with over 3 million customers, routinely processing about $400 billion of monthly turnover. And our goal is that every Indian, no matter who you are, no matter what your level of financial literacy, should be able to build and maintain your personal wealth better. Very glad to be here and look for a great discussion, guys.
I love the Sarson Ka Tel story, Kavitha. Awesome. We are catching up today at a rather opportune time, I must say. In the last year or so, wealth management and investing in general has really come at the center stage of financial services and captured the imagination of the broader public, not just in India, I'd say around the world. If we were to look at active brokerage accounts, for instance, the data which gets reported by the NSE, and brokerage is only one part of the wealth management, money management market. The numbers there are quite telling. NSE reported 10.8 million active investors in India last year, which is March of 2020. This number had grown by about 2.5 million active investors in the preceding 2 years. So between March of 18 and March of 20, the number of active investors in India grew by about 2.5 million, from 8.3 million to 10.8 million. Over the last year, this number has grown from 10.8 million to last reported number was 18 million. So in the last year, India has, we'll yet to get the March data, but in the last year, India alone has added 8 million active investors on brokerage, while India was adding about 2.5 million in the preceding 2 years. It's not uncommon anecdotally to see, Uber drivers, log into their Robinhood accounts in the US, and the same with Grow and Upstocks in India. So really, wealth management and investing has come at the center stage of financial services. If I may start with Kavitha. Kavitha, Upstocks has been in India and has been active for close to a decade now in both Upstocks avatar and the RKSV avatar. How have you seen the industry evolve? And how has Upstocks evolved as a consequence of that?
Sure. Thanks, Ashish. So, honestly, we feel very privileged to have had not only a ringside view, but to have also actively participated and sort of helped drive a phenomenally explosive growth in this space, right? After being stagnant for decades, the number didn't even budge between 2004 and 2015-16, the equity participation in the country, but it doubled thereafter in the last 5 years, right? And there's one man chiefly responsible for this. We heard him earlier today, Mr. Nilakani. Right. So pre-2016, opening a demat account was an excruciatingly painful process, a 30-page document that one had to essentially, if one was not in the metros, download, print, sign at 42 different places, and then courier it in, right? And even if one signature is missing, that's it, form's rejected. So as you can imagine, the participation outside the metros is quite low. But in 2016, because of the Aadhaar e-sign, suddenly this entire process went online only, and you can open a demat account in a matter of minutes, no matter where you are in India, right? And what they did is not just massively explosive growth in the numbers. So for example, pre-2016, we were opening about 500 odd accounts a month. Today, we routinely open close to 5 lakh accounts a month. That's a 1000x jump in 4 years in monthly account opening, right? But what is even more exciting is that the story that was predominantly an India metro story has now become a Bharat story, right? A full 80-85% of our accounts are coming from a tier 2 or a tier 3 location, right? And most of these people are young. A good 80% of our customers are below the age of 32 years. Millennials are participating in India's equity story, and that's fantastic. And I think what's even more exciting for us is a full 65-70% of customers onboarded at Upstocks are actually first-time traders. They are entering the equity retail markets for the first time through Upstocks, which makes us feel really good that, we are doing our bit to sort of help improve participation in the country, right? So that's been one major change, huge jump in volumes, movement from sort of an India to a Bharat. And a second sort of wave, if I may, is, the best example would be what IPL is to cricket, is essentially what now players like us and Grow even are doing to the world of financial services, right? So what did IPL do? Cricket's a gentleman's game. It has its own set of ethics, etc. IPL kept that intact, but it sort of tweaked the format to make it more interesting, make it more colorful, make it more engaging and relevant to a young audience, right? And that's what we are all focusing on right now. How do you make financial services, how do you make financial literacy, the content around it, far more engaging, far more appealing and interesting to a younger audience? How do you really spread awareness across the country? How do you make the act of managing your personal wealth exciting enough and engaging enough that you want to do it, right? As it stands, it feels like no one bounded out of bed ever saying, yes, today I'm going to go out and manage my personal finances, right? But how do you make that easy enough so that something which is a matter of responsibility, you keep those ethics front and center? We have Mr. Ratan Tata as an investor. So you want to keep those ethics. You want to keep that investor centricity front and center. But how do you make it more engaging? How do you make it relevant to the youth of today? It's sort of the way in which the market's evolving.
Awesome. No, I love the analogy that you point out. What IPL is to cricket, effectively Grow and Upstocks and Zerodha perhaps are to the
absolutely
interesting. Lalit, if I could get your thoughts on this as well. Robinhood has driven massive retail investor participation in the US, and you guys are attempting something similar in India. What's your perspective on the market?
So yeah, I think Kavitha has covered a lot of aspects about Indian markets. I would add just one more to it. So what we have seen since 2015-16 is, right, multiple things came together, right? Okay, so you are Aadhaar e-sign, basically the entire digital India movement by Indian government. People like us, like, Upstalks, Virodha, Grow, making things simple. And one of the biggest factors is online content, right? YouTube, Twitter. So if you see like the awareness today, effectively, a person sitting in Patna has a person sitting in Bombay has no extra arbitrage than, somebody sitting in Patna. Like completely, the boundaries have been completely kind of vanished today because of the popularity of content on online channels, right? And then in addition to that, wealth moving, like traditionally the mindset of Indians is moving towards financial assets. Like if I compare to my dad, who has never invested in mutual funds or stocks, but if I look at myself, I don't remember. I have zero investments in real estate, right? So kind of multiple trends coming together. Now we can be wise to say in hindsight, okay, this happened and that happened. But I think there are just too many factors. We should just enjoy the wave.
Fair enough. Jiten, maybe switching gears, we've talked a lot about brokerage. You are a second-time founder, and you are playing this market with a savings hook versus an investments hook. Talk a little bit about how you thought about as you thought about your second entrepreneurial journey. How did you see the landscape, and what are you attempting to build at Jupiter?
Sure. So Ashish, if you've seen like my first two stints have been in like payments and consumer lending, and I think what I realized over a period is that in last 10 years, when I look at the fintech as a space or financial services as a space, I think somehow most financial services franchise build like a transactional relationship with consumer. So like in payments, you sort of do a transaction and you move on, or in lending, you take the loan and you move on. But there's no trust which is being formed where it sort of lasts long. And when you look at banking, irrespective of whether bank does a good job or a bad job, doesn't matter. You still keep your money there, and there is a trust that okay, my money is lying there. I got to trust these guys. It's safe. So when I was sort of deciding my own venture this time, one, I was very sure that this time I want to do like something like really, really long, and financial services is the only thing which that I understand, and this is where I'm like, why not sort of look at banking and create a experience which is more comprehensive. Today, if you look at from a consumer standpoint, bank account is like a very siloed account, and sort of you have this brokerage accounts, then you have in the whole lending and payments, and like the experiences are fragmented. And thanks to the guys who are doing like pretty good in each of the solutions. So, but from a consumer standpoint, this is not optimal the way I see it. And the consumer is like, okay, now for my X, I go here, for my Y, I go there and all. So, and this is where I sort of like, why not sort of give a experience to consumer which can have everything access at one single point, more intuitive, and the financial advice which you provide to the consumer is sort of considering overall financial well-being of the consumer rather than a point or a specific point which you are sort of considering. So that was the whole idea of Jupiter, and I sort of see this. So when I started, frankly, last year, I was like, and like honestly, I was like not very clear that how this path will evolve. But now, after within 12 months of the journey, I think I'm like super convinced after working with banks and all of that this is the path which is like a real opportunity lying ahead in India, and like consumers are like really looking for an experience which is more personalized, more intuitive, and at a single place rather than a fragmented way.
And then, each company attempts to build a diversified financial services offering across multiple products over time. Would it be fair to say you would reckon the savings account is a better hook than an investment account?
So saving account is the most difficult hook. I must say that, and I must admit that, because it's kind of considered more of a push product rather than a pull product. So, but my thesis is that if you're able to sort of penetrate that, I think then you're sorted. So I sort of took the tougher path from that standpoint. But I think this path is a longer but a more rewarding path from my journey as well as the consumer journey standpoint.
Awesome. Thanks for sharing. Puneet, if I could maybe shine the torch a little bit on the large banks. And I'm sure many panelists have experiences and anecdotes to share on their dealings with the large banks. But you represent JP Morgan and the other large banks, have a significant share of their revenues coming from wealth management. And to my knowledge, it's only been increasing over time. Wealth management is an increasingly more and more important part of their business line. There's lots of M&A happening. Morgan Stanley acquired E-Trade. I know you guys have been making acquisitions also. How do you see money management evolve, both, and maybe you could share both the US perspective and the India perspective here?
Thanks, Ashish. Sure. So banks are like 500-pound gorilla in this space. So no discussion can go forward without them. So I think there are three key trends emerging in this space, which I could see from my perspective. The first is that the large bank, they themselves having a lot of digital offering nowadays. So to give you some example, JP Morgan has this robo-advisor offering. We call it You Invest Portfolio. So I think that gives you sort of betterment and wealth front kind of experience. It's more US-centric. And for the offering like Robinhood, we have called You Invest Trade, which can give you a brokerage trade. And we are not alone. Like this whole industry is evolving towards. Let's look at the Schwab has their own robo-advisor. The Vanguard, the ETF Pioneer are coming in that space as well. So this is the first trend of banks offering digital to reaching out to more customer and increasing their presence. The second is that large bank investing heavily for innovation. Like, and you'll be surprised, like we just for spice a little bit, like, we talk about fintech, like, so we invest like 10 billion a year in technology. Like this is not a small money. This is like, pretext dollar going here. So to give you some example, like we have a huge center called Flare to invest in quantum research. So my team is working on some of the projects where we're figuring out that how the quantum compute can use portfolio optimization. So there's massive stuff going on in AI, crypto, blockchain, and I'm going to touch base later on. So this is a second trend that banks driving innovation there on stuff. And third is that like we don't see startup as a threat. We say, look, they open a fresh thinking to us as well. So they're acquiring a partnership. So we just acquired something called 55 IP, which is a small firm which talk about more tax-aware investment. This is more US-centric, tax lot harvesting, all those stuff. Goldman has a collaboration with Apple and Amazon, like, and you saw Amazon cards, Goldman have Apple cards and all those stuff. And you talk about E-Trade and all. So I think long story short is that these three trends are mostly for consumer-centric, which is very question you asked. But there are a lot other to banking, like there's tons of things going on in innovation in terms of institutional, in terms of large deal. And that's where bank is playing key role. So I really feel that this ecosystem is evolving very fast, and both the players have their space in the pie or in the market.
Lalit, Kavitha, any perspective from you guys? If I could pick on this, the bank versus specialist startup kind of a question for wealth management and broader financial services. Any perspective from either of you?
Yeah, absolutely. So first up, we have massive respect for the large banks in India, like an HDFC and ICICI, and the remarkable franchise that they've built over the last few years. It's just phenomenal globally by any standards, right? Look, that said, there are certain niches where, and the example that I'd like to give is from our sector of broking, where the number one and the number two brokers in India today, Zerodha and Upstocks, are non-banks. And today we are ahead of an HDFC Bank and an ICICI Direct, which have been in this business for a long while. That said, I do feel like there is a massive potential for actually co-opetition and a lot of cooperation actually between banks and fintechs. So let me just give you this example, right? So what's worked for the fintechs is A, we're nimble, and B, we really understand the consumer and things like UI, UX design. And for example, Upstocks was a pioneer in 2016 itself of a fully paperless online digital onboarding. The rest of the industry probably followed suit by end of 2017, but the banks only now during COVID, right? So that nimbleness is something that would really help fintechs sort of cater to customers in a fast-paced environment. But one of the things that has worked very well for us as well is we've actually partnered with a bank the IndusInd Bank. And what we're offering customers is an unbeatable combination of the best of what a bank has to offer and a startup like us has to offer, right? So, for example, you can now open a 3-in-1 digital broking and bank account where a customer enjoys the 6% savings rate from the bank side, even on your balances with upstocks, which doesn't really exist elsewhere in the sort of digital broking industry. So these and other such models, I think, can evolve in the future. And if you look at the US markets as well, for example, Robinhood is making phenomenal progress there, but the banks haven't died. Charles Schwab and E-Trade have been there for a while. The banks haven't gone away, right? So there is certainly, heft in what the banks are doing. They're very good at what they are doing. We are very good at what we are doing. And I think that there's certainly potential for the two of us to come together and deliver something even more spectacular to a consumer.
Lalit, anything more to add on this debate?
Yeah, I think I agree with Kavitha. We also have a lot of respect for banks. They're our role model, but they suck at some places. And I think Jiten was telling about, I read that, he started with something last year, but over this last 1 year, he got some lessons and conviction. We have not very closely worked with banks like how Jiten has. I think I would love to hear him. What was that 1 year experience that changed him basically? Or, yeah.
Yeah, Jiten.
So Lalit, so frankly, what I've learned is, I thought by looking at the surface that, I think the COVID must have accelerated the bank's mindset or progress or thinking, or I think by looking at the way fintechs are delivering, maybe they must have evolved. And at the surface, it looks like, by the way, that they have a good digital offering and they're doing many things paperless and all of that. But the reality is the mindset is not changed. The reality is, like when we sort of tried creating a bank account with a couple of partner banks, none of the banks understand the importance of APIs, the security of APIs, API structure. Like these are issues that are as basic as those. Forget the product construct. And the product, like I'll give you a simple example. Like when I say, like we want to control the customer service for the set of customers we onboard. And it's been 6 months, I've been fighting with our bank partner saying that this is the process in the digital world we want to deliver. And bank is like, no, but in our bank, the customer has to call. So I'm like, it's as simple as that, they don't understand. So this is where I'm saying that I'm like super convinced in last 1 year. So like, fortunately, I was lucky to raise money before start of the venture. But and it sort of happened on back of my last credibility, thanks to Ashish and the team there. But now it's easier because now I have the actual proposition that why we would do better at what we deliver.
So will banks die?
No, I don't think so, frankly, because I think the good part or the bad part is in India, there is something which has been protected for institutions of trust, and that is through a regulatory structure. So I think from that standpoint, I don't think that's going to happen. Second thing, I think if you look at market like India, on a 1.3 billion population, everybody needs banking. And there are 100 banks. And the way, if you remember when Kotak got licensed in 2003, people were not very convinced that Kotak will do any good. But you look at 17-year fast forward, is in the top 2 banks or top 3 banks now. So I think there is enough space, enough room, even for, in my view, 20 new banks to come in and sort of deliver the services they want to the Indian consumers. Because while some banks might lose some share, but I think the market size is sort of pretty positive and healthy for new players to come into this segment.
Got it. So Ashish, just to complete my answer, thank you so much, Jiten, for filling there. I think if you look at the banks, top banks today, like HDFC Bank, you know that that's like our role model. Then we talk about Axis Bank, ICICI Bank. They started in last century, and they are very young, by the way. They are not very so done phenomenally well over last 25, 30 years, if you see, right? I think they are also trying to evolve into this new, and this is, as we were talking, this trend started in 2015-16, like really kind of the inflection point was there. They're taking a time to catch up, but I think I think there will be a war between three. It will be like a three-way kind of. It will not be like a war, but there will be three kind of people who will be participating in this. Startups like Twitter, Grow, Upstocks, Zerodha. And the second participant will be big banks like HDFCs of the world. And the third would be like big tech, what I call like Google, Amazon, and those kind of folks. I think there will be value added by all these three, different value added by all these three kind of different sets, and together overall the ecosystem would kind of grow from here.
So I think I just want to add just a couple of things Ashish like is speaking up. So I think I see it.
By the way, sorry, this panel is being a little bit lopsided in the number of people who are bank backers and you are being left to defend it alone.
No, I think we are in good company. So I think the important point, I just want to add two perspectives. Like, my personal perspective that US side of house are a lot more innovative compared to our Indian counterpart, which is my personal view. To give you some examples, so Jitendra talk about API. So we have our own API store. Like, our partner banks have an API store as well. Some of the bank is joining the bank, launching banking as service. Like, you can really build. That's why it's so easy to offer a co-branded credit card offering so quickly nowadays. And I think that become a trend. I think because large bank in globally, they invest so much in technology. Like, I can tell you what we talk about fintech. Like 20 years ago, we are doing a lot of tech-based financial modeling. Like, so that was part of a large bank anyway. But I see these trends need to solidify our Indian side of a house as well. I just want to another perspective. In this forum, we're talking about only sort of customer, which I call it low touch. Like, low touch, mass volume, and low customer value. But when you come to high touch, the bank has done a lot of innovation, and they need a lot of high touch services, and that's where bank also play a big role. So what I'm trying to say in both the spectrum, like low touch and high touch, the US sort of house driving a lot of innovation, and I just want to call out two things. So Chase app is the top app in US by JD Power Associate. It's not like our colleagues here in India, where I struggle to do things on. I would rather go to Grow. I was looking for a mutual fund platform for the last 2 years where I can invest everything and look at all my holdings. And thanks to Grow, and I was really looking forward to do things stuff. But that was missing here, where you can just look everything one guard. But in US side, things are a lot more progressive. So I think we can coexist, as Kavitha mentioned, that there's a space for everybody and to move the cheese forward.
Awesome. With that truce, let me switch gears to a different topic. The one other development over the past year in the world of investing has been the emergence of kind of new asset classes, and cryptocurrencies has probably taken center stage there and been the biggest one. Any perspectives? We could start with Lalit perhaps on how you guys see this sector evolving, and how would Grow look to play it?
There are only 2 points, Ashish, here. My customers want crypto. That is number one. But I'm not yet clear whether I should offer crypto. The day government or regulations allow me to offer crypto, we don't want to get into any gray zone. We are 100% like, okay, 0% compliance breach, 100%, be 100% compliant, be 100% regulated. The day ministry, government regulations come out, I think we'll take 90 days to launch, less than 90 days to launch crypto.
Kavitha, would you think new asset classes need specialized players, or would you think the existing players, like Lalit is saying, I need a time to launch, Upstocks and others will be able to offer whatever new asset classes are coming out on their existing platforms?
Well, absolutely, right. Exactly like Lalit said, customers want, customers get, right? And again, I just want to say that what we are waiting for is sort of clarity on the regulatory side, but with a sort of a slight aside. If you look at the US, by the way, there is a bunch of standalone players which are in the crypto space and highly successful in the crypto space as well, right? You have the Coinbases and the Krakens of the world. We also have a Robinhood, which has ventured or early stages of entering into crypto, right? So both the models have been existing in the US. So I see absolutely no reason why not. And the second thing I want to say is that, as a slightly aside, is that, look, India is doing very well as an investing market, right? As an investment market, in the sense that the NSE is the largest derivatives bourse worldwide, larger than the Nasdaq and the NYSE, and the third largest cash segment market in the world. And India is one of the safest destinations with the most robust systems and processes protecting the retail investor. And I would even say far better than some of the practices in the US. So our regulators done a phenomenal job in protecting the retail investor, be it PFOF kind of laws, be it having a clear DMAT style account, or even insisting on an income proof for someone that wants to do a futures and options kind of derivatives trading, versus not having that barrier for a simple equity trader. So I would wait to watch very clearly what the regulator has in mind for this space, and how that policy evolves. Mr. Nilekani earlier today also alluded to this and said, look, currently it doesn't seem like there is any move on the regulator's part to sort of open up cryptocurrencies, but potentially a digital currency for India may be launched. And so, we will just wait to watch very, very early stages at this point, Ashish. I think it's way too early to comment which way this market will go, which way players will go. But certainly, if there's a demand by customers and regulations are clear, we will absolutely go ahead.
And just to add one more thing, Ashish, our securities market has evolved over so many years. Like the framework that we have is like much, much better than any other country, by the way. They protect the retail investor really, really well. Crypto, there are certain aspects. So that's why we are like so crazily waiting to watch the crypto regulation. There are certain aspects that we will have to kind of solve before, that becomes like a retail investor's game in India.
Well, how should one, there are lots of retail investors in the audience today. Well, any guidance, any inputs from you guys as they think about crypto as being one new asset class, NFTs, of course, and then a new bunch of new asset classes are emerging. How should retail investors think about it from any of the panelists?
I personally feel they're highly speculative. Retail investor diving into crypto is very, very interesting because you need certain kind of sophistication. It's not I call it jua. You really have to have, if you have a skill and you can figure out things. But in general, I would say that because this is unregulated space, still emerging, so I would rather play safe. I consider myself an aggressive investor, but this is the area where I still I was asked to invest when it was $2,000 a rate, and now the 40,000 above that things are trading. After thanks to Mr. Musk and putting the 1.5 billion there, but I would really caution them. I would really want this space to emerge. I think, and just to add additional to this, like crypto is just one piece which keep hearing, but the biggest puzzle or biggest important thing is blockchain, the technology underlying it. And I just want to spend like 30 seconds here. So like we in JP Morgan, we have launched our own currency called JP Morgan Coin in US, and that's driving huge payment revolution across the for US dollar denominated assets. At the same time, we created something called a link, which basically link the permission blockchain where large institutions can come together and transfer data. So there are tons of activity going on in that space. So I certainly feel that central bank direct currency, which Mr. Nilekani talked about in the morning, and if the Bahamas and Sudan are actually doing a pilot on it, on those kind of currency, and that's the space where more clarity emerges, and that's where that will drive again the low touch user having banking to unbank. That's where I would say a lot more silver lining. But right now, I would feel highly speculative. Go with caution.
Yeah, Ashish, somehow I've got slightly stronger views here. So I feel that crypto is not for retail investors strictly. And for the sheer issue of volatility in the asset class. So where the volatility is so high, generally I have seen retail investors losing money rather than making money. So from that standpoint, strict avoid. And I think even for other set of investors, the guidelines need to come in terms of how the margins and the requirements and all of those kind of stuff which need to happen before this asset class is formally being introduced. Otherwise, frankly, you're playing a roulette casino. So if it hits, it hits. If it doesn't hit, then you lose everything. So I think it's like that.
Okay, diverse perspective from the panel. Audience, take it for what it's worth. Looks like the panel is a little bit cautious, if I may summarize on crypto. Um, by the way, we are kind of 35 minutes in. We have 25 minutes more to go. We'll try and complete some of the topics that we had in mind over the next 10 minutes, and we'll open up for Q&A. So, but to the audience, please start sending your questions in, and we will take them as and when they come. One of the questions here is around the Robin Hood saga, around the GameStop episode, the Reddit episode in particular. If I could maybe talk a little bit, turn the attention to that issue. Clearly, the world is moving towards a more social form of investing, and people are teaming with each other on Reddit platforms, and as a consequence, going with the flow when it comes to buying individual brokerages, individual stocks and brokerages. There's also a very heightened degree of activity on these brokerage platforms. Just the amount of trades being entered to by retail investors. Jiten, if I may ask you, you sounded a bit of a cautious alarm on crypto. Do you see concern with the amount of trading activity that is happening?
I'm not that conservative guy, Ashish, so maybe you bucket me that way. But the way I see, before I go to the amount of activity on trading, because I don't know which kind of people are trading. But the way I see in India, I think the nuance has been a little different. When you say social investing, I think India is kind of social investing. Because today, at least which I see most people around me, they have zero clue about investing. They'll keep calling, oh, where do you put money? Where can I put money? Which stock to buy? Which stock to exit? Or which mutual fund to buy? So I think the knowledge about where to invest and how to invest, in which asset class to invest and how much to invest, I think it's just not there in India. And somebody needs to do a pretty good job. I mean, somebody is the ecosystem or the industry needs to do a very good job in doing that. And then we will see the volumes automatically increasing. So, I mean, today there is very less population or the percentage of population which participates in the stock market compared to any other part of the world. So I'm not concerned that there's too much of trading activity, because in my view, it's too less. So I think this is a one-way street. And I wish I was also in this segment. But anyway, since now the segment has been taken over very well by the people here. So, but I'm saying, and they are on a classic ride for next decade. But the way I see is that once the financial literacy job is done and sort of made understood that what entails, what kind of investment and what risk and all of those, and sort of trends and more research and all of that, I think we will see a way better participation from retail investors. Today, the participation of retail investors is very, very small because of the lack of understanding. But the trading volume which we see is mainly coming from the traders or the institution guys. And I think which is a fraction, I would say, of what ideally it should be.
Maybe moving on to the GameStop saga, Lalit, was the incident worrisome? And any thoughts on how do we expect more of these to happen in the future?
Yeah, just stock markets are always exciting. This is not the first time it has. So stock markets has two components. One is the companies that you are investing in. What we as Grow also we try to educate. Okay, you are actually investing in companies for long term and so on. But then there is the human behavior that is involved. Stock market, millions of people are participating, buying and selling shares every day. And then these kind of stories happen. And incidentally, when this was happening, I was reading a book called Business Adventures, which was recommended by Warren Buffett to Bill Gates. They talk about a company called Piggly Wiggly. So Piggly, it's around early 1900s, right? Their also founder tried to do the same thing, what happened in Game Saga, cornering the stock, right? Of course, the episode did not end well and so on. Anyway, the point is that stock markets will always be exciting. There is inherent gamification, and not gamification on steroids. They're pumped in gamification. So there will always be interesting stuff that will continue happening. I think as retail investors, we don't give advice, but anyways, I'll take the liberty to give advice, is to be aware about what is happening. Like, don't run where everybody is running. If you're just aware about what the thing is, what is actually happening, like, watch the show, but participate in the long-term story of the country.
I think I just want to add. I want to add important perspective on this one. Look, somebody told me long ago that investing is not more about making money, is not losing it. All right, so you can't be 2 steps forward and 5 steps backward. So the whole concept of social investing. So look at how do you discover a price of asset. Okay, it's a consensus of what all think is the price. So if you feel that the security behind you is like worth $100,000 and Kavitha and all feel like $500,000, the value will go up. So the social investing actually driving that frenzy. So I'll give you very important data points. There is a vendor called ThinkNum, okay, which now just launched a data set which basically might give you a Reddit mention. So Wall Street Bet, the group that where GameStop, interesting thing happens. So it'll give you that, okay, which NYSE or NASDAQ ticker being talked and how many times it talk. So that creates this kind of frenzy about investing. So I would really feel these kind of things are speculative gamification, but we should take a really caution because it's not where herd is going. Because ultimately assets go where their intrinsic value is. Okay, the pendulum will swing. So I would feel that this whole GameStop, Robinhood saga sort of, like, I know retail investor giving it back to some hedge fund, a small punch, somewhat. I will feel it this way, but people should be really thinking about investing. Like, just be really, really watch your risk, because you don't want to make 100,000 one day and lose 500 other days. That's what I would think. Sorry, Kavitha, I speak for you. Yeah.
Kavitha, totally. While you add your perspective, one of the questions here is around the payment for order flow. Business,
sure.
How it came kind of to the fore with around the Robinhood GameStop saga as well. Maybe you can touch upon that as well.
Absolutely. But first, I just want to add that I kind of disagree partly with Lalit, but also agree partly with Lalit. So the point of difference is that I, once again, would say that the Indian market has done a very good job of being well regulated and focusing on retail investor safety, right? So we have a ton of regulations here, against naked short selling, for example, or you have market-wide position limits. There are constraints or even sharing and socializing what your holdings look like, right? So the regulations in India will, to a large extent, also help limit the kind of issues that the US is facing today. My second thought is that, fundamentally what Warren Buffett says is, in investing, you got to be greedy when others are fearful and fearful when others are greedy. So what does social investing mean even, right? The whole point is to sort of be a contrarian if you want to make your returns. So my thing is that in frenzies like this GameStop, and exactly like Lalit said, these are psychologically driven, and it's really the retail investor who loses. So abundant caution required to proceed on processes like this. Really it's the retail investor who lost out in the US as well. And when it comes to, PFOF, which is a big reason why Robinhood is also being hauled up to Congress. So PFOF is a very interesting concept in the US, right? Payment for order flow. Basically what some of the large players in the US do routinely, and not just Robinhood, by the way. So suppose there's a bunch of retail investors placing orders and trades. What they would do is they would take those trades and they would sort of sell that information to an intermediary like a Citadel, who's a market maker, and you do need them to introduce liquidity into the market. But sometimes what ends up happening is they use that information to front run their own trades, which means that the retail investor who originated that trade is actually seeing a poorer price for their order fulfillment, right? So they're not seeing the best returns on their investment. And that is how, because there's this concept of being paid, a Robinhood is being paid by Citadel for actually selling them, Ashish's and Lalit's order flow, right? And therefore, Ashish and Lalit are losing out. Now, the interesting thing is PFOF is fully legal in the US. It's not ethical, perhaps, but it is fully legal in the US. And there are multiple players that actually do this. And there are large players like even Goldman Sachs, Citadel, a bunch of them well-known names who are in the industry on the other side. And this is a regulatory issue that honestly the US policymakers need to address. This doesn't exist in India, by the way. There is absolutely no concept of PFOF. You cannot front run here. The retail interests are again very well protected, and that's why I would insist again that we have much to be proud of in the Indian ecosystem here. The regulators have done a phenomenal job. The whole set of players, NSE, everybody done great here.
Yeah, there was an analysis being published which said that the average Robinhood trader, perhaps despite the platform being free, ends up paying more than
absolutely
than on other brokerages because of the run up in stock price when they are.
Yeah. To be clear, the large banks are doing PFOF too, but unfortunately, Robinhood is the one that got caught in the crosshairs this time.
Ashish is frozen.
I think he's just spellbound with the concept of PFOF.
Well, let me ask, maybe till Ashish is live.
Yeah.
Jiten, like in 10 years from now, let's say, so there was a PSU saga that, well, everybody used to bank with SBI, and then HDFC banks came, the private sector banks came, right? There's a big question mark, okay, how long are we going to kind of go with that? Or are we going to see like newer banks coming in India? And because in US and in UK, we are already seeing Revoluts and Chimes and and when are we going to see that? We want to see that in India. Should we have it in India or not? Like, first of all.
So I'm for it, right? So, and that's why the ventures like us are sort of trying to foray into it. I think today the way the regulations are being formed, they are being formed keeping the whole branch network in mind, and how many branches should be, and the geographical dispersion should be there for addressing the every segment of consumers. And I think this is I would say the difference between the other markets and here, where the other markets are like the players are allowed to go after a specific segment, build a business on top of that. And fortunately, like this whole digital banking licenses, which has been sort of formally recognized by the UK, US, Singapore, Taiwan, Australia, I think has become reality in terms of the way players have come in, showed that they can do much better job for a segment of population. I think when it comes to market like India, till date, I think the regulator the focus was more around increasing the penetration of banking in rural India or the every segment of unbanked population. I think when I look at the last 2-3 years, what has changed? The internet penetration has changed. The smartphone penetration has changed. The banking penetration has changed. So now the hygiene issues are being solved to a great extent. So now maybe it's the time where regulator, and to my knowledge, I think regulator is taking a view. Then maybe it's a time to sort of have a segmented players, and which I think they did something which is SB or Payments Bank and all of that. But maybe they will take one step more. The segmented players come in, address the specific segment in a way better way as compared to what the existing players are doing. So I think if that becomes a reality, gradually we will see like the way we saw the private players chipping off from PSU shares. Similarly, we'll see a segment of population chipping off to the new age players. But the good part is that the India is such diverse market and such wider market that the one strategy fit all approach will not work. So I think it will work for a segment. So you got to pick up your right segment and the proposition around it.
Great, thanks, Ashish. I just filled in for you while you were away.
Yeah, apologies. There was some network trouble at my end. Thank you for bearing. If I could move on to the last topic we wanted to cover, and there's a few other audience questions we should take as well, which is on technology and how it is kind of leading to advances in investing. Puneet, if I could start with you first. Give us a peek on what's happening from your vantage point. You guys are investing $10 billion a year in advanced technology. And just how are banks leveraging technology to make investing more advanced, and use of AI and a bunch of other things that's happening in investing now?
Sure, Ashish. So I think the important piece is the broad spectrum of 2 or 3 waves, like the usual technology stuff that we're doing, automation, all the other. But the big focus is towards AI. I think AI is using, let's say, 2 broad categories, I could put it. The first category I call it, which is pretty run-of-the-mill, called driving efficiency, which all of us in this room are aware of. Reaching out to more customers, driving the operation process better, deepening relationship, targeting. That's what's happening. But the more interesting stuff is that how do you use AI for generating excess return? And that's where things start getting pretty interesting. So we are working on a variety of stuff where AI is used essentially to basically generate excess return. I just launched a small set of model which basically predicts the probability of companies failure. We are in the process of, I can't give more detail, but there's some discussion about building AI-based fund, which all the technical, fundamental, and all the social signal can be part of the discussion. So I think for audience benefit, this area is where where rubber meet the road, and where basically if you can drive excess return, that could really change the whole spectrum industry. And we are heavily investing on that. We've been putting a lot of our money around that.
If I can talk about 2 specific aspects of technology which are maybe relevant to India, and we covered a little bit of this in previously as well, but from your experience in payments in particular in the past, what are the advances happening making investing easier in India?
I think, Ashish, if you look at it, the number one thing which really worked out in India is this whole ASBA facility. And I think that has been proven to be a boon to retail investors specifically, or even maybe large investors, where actual money is not moving out of the account, and you're still having the sight of your money. And otherwise, I remember 5 years back, the whole money sort of moves out, and then the refunds come in, and then you sort of effectively don't have the sight of your money for 15 days or like 20 days. So that is the super innovation. The second is this whole UPI based investing, which we recently saw in last 1 year. I think so it sort of made it really simple to invest. And the third is, from an investing standpoint, this whole the mandate setup process, how that has been automated for the retail investors, and there's literally zero paperwork if you want to set up your regular investing. So I think these are pretty good infrastructure rails which have been put around payments.
Kavitha, anything to add from the Aadhaar, from the KYC angle? You mentioned you've gone from adding 500 accounts a month to 5 lakh accounts a month like this. How has that been enabled by the build out of infrastructure?
Yeah, look, clearly technology has played a massive role in sort of the account opening, going paperless, going digital, right? And, honestly, Ashish, by now that's almost a done story. And I think we've spoken about it a lot, not only in this panel, but all of today. And certainly technology is going to play a very important role going forward as well. So for example, previously where we were manually processing KYC documents, it's now fully automated. And there's a sort of a automatic AI sort of probability check on, is that scrutiny right or wrong, right? So that's certainly business processes are being automated and moved forward via technology. But what I'm seeing is a very interesting trend that never happened. So a few years ago, there was a massive hype around the rise of the robo-advisor, right? But if you see in the US, Robinhood is a self-directed platform that's about to be worth close to $100 billion. But a Betterment and a Wealth Front launched much before a Robinhood are at a fraction of that valuation today, right? As an armchair intellectual, you would have predicted, a lot of people did predict, sort of everybody's going to love to just give their money to a robo-advisor AI model that's going to be so much better than human at sort of investing and generating the alpha. Never took off in the US. A bunch of startups in India that just never took off 2 years ago. Right? Or 2 or 3 years ago, I'm sure you guys were at the forefront of seeing a number of startups that came in that space, right? So that's a very interesting trend that never happened, right? And what we're seeing instead is the rise of the self-directed investor. the average investor today, the millennials of today, they want to be a part of the process. For them, it's almost as enjoyable as going shopping, right? In a way, you want to experience it, right? They don't seem to want, and this is surprising to be honest, but they don't seem to want here's a final answer, take it, right? In the distant future, are we possibly going to see a sort of a deep blue versus any other massive AI model fighting it out in the stock markets? Possibly. But I do feel like today we are a bit away from it. The next step seems to be AI assisted. So for example, what we are going to be focusing on heavily is taking your trading insights, taking your trading history, and sort of giving it back to you saying, hey, this is the insights that we are able to generate from your data. What can you learn to make you a better trader on our platform and a better investor on our platform, where the decision-making still lies with the investor, with the human at the other end, right? So that's sort of the progression we're seeing next. Somehow, it just feels like the whole world is super automated, maybe a step further, but hey, we'll wait and watch.
Lalit, if I can, thanks for sharing those anecdotes, Kavitha. It's super interesting. Lalit, if I could pick your brain on there's this dichotomy we are observing in the market. On one hand, we're talking about robo-advisor and just like AI-enabled investing. On the other hand, we are about to see LIC go public. LIC is probably the most basic instrument that has been, we've been investing in for the last 4 or 5 decades, if not more. Just like, how does this dichotomy exist for the Indian retail investor?
See, I think, one reason what I can think of is India has primarily been a push-based industry. So today, as we keep talking, 2015, 16 was the phenomenal moment when people like us and everybody, all tech guys, started getting into but for so many years, it has always been push-based. You don't buy financial products. You don't buy insurance. You don't buy stock. Now you buy stocks, of course. Now you buy mutual funds, but you used to be sold mutual funds, and so who wins when it is a push-based industry? The one who has the biggest pushing engine. And I think LIC has built a phenomenal engine to kind of get in touch with millions of customers in India. And I think this return concept, Ashish, is very complicated for anyone to understand. I mean, if you ask me, okay, how much return have you made in last 15 years of investing? I will not care as far as, I have made decent return. And now if you're used to, you're getting 3%, 4% on savings bank account, I'm getting like 4.19%. Somebody wrote an article, the most popular policy of LIC has generated for some X percentage yield, which is like very low. It's like, so what? So I think that's the thing. It's very hard for us to understand concepts like, what is the inflation? What is the ARR that I have generated? IRR that I have generated? Or, what is the alpha that I can generate? I think we just live in hindsight. And that's what explains us. There are a number of choices that I can do today, right? And I think I would go to the choice which has the least friction. And if somebody is calling me and telling, Lalit, LIC ki policy hai, this will help you when you are living to get you this much interest. When you die, your family will get this mix of insurance and investment. You are smart. Where should I sign? And I sign it, right? That's so simple for me. That's what I think. It's human behavior rather than the concepts of returns versus inflation and all that kind of work in India.
Awesome. We are kind of coming, but maybe we'll take a couple of last audience questions. And please feel free to any one of you and answer this. So the question is, with Google now to join banking space, how do you think that will impact banking and other fintechs? We touched upon, Lalit, you touched upon this a little bit in your third pillar of type of players in financial services being the Googles of the world. You or for anybody else would like to take this?
Yeah, I think, Puneet, you want to take it?
Sure, absolutely. So I think, I see, I think a couple of years back that there was sort of fear in a established player that the big tech gonna come to the banking. But I think the the more important thing, likes of Googles and Amazons and all, they basically stayed more in collaborative approach because look, this is a highly regulated industry. Look, when you're scratching the surface, this looks pretty easy, but when you go deep, you need to go to all the regulations. So Googles and all, Chimes and all, they are sticking around to a small set of offering. And I think that's where we banks like us and everybody else would like to collaborate. So it's good for us to basically make the pie bigger, get more access, remove the friction as Lalit talk about, and that's essentially the piece of it. So I really feel that these are the great moves which eventually going to help all the players. And I think big tech, the kind of usability and kind of, I would say, access they have, the massive data they have, would really gonna make things interesting for all of us. So I really feel that that's a great outcome for all the players in the market.
Also, and maybe one last one from the audience. What is the future of hedge funds in India? And why are there no large funds, hedge funds in India? Anyone?
Ashish, you should take that.
Yeah, you are the most qualified.
Yes.
I would say that it's happening. I think the investor capital is getting aggregated more and more. And there are a few large funds in India, but we will see more and more large funds start to attack Indian public equities market, just like there are lots of players in the private markets as well. Perhaps on that note, maybe we could thank all the panelists. Thanks, Kavitha, Lalit, Jitendra, and Puneet for joining today. Thank you all in the audience for joining today as well. It's clearly a very exciting last few years for the industry. And as Kavitha mentioned, we're standing on the shoulders of giants a little bit, enabled by innovation like UPI and Aadhaar and many others that has enabled the expansion of this industry materially. And we couldn't be more excited about what comes in the next few years. Thank you, everyone.
Thanks, Ashish.
Thanks, everybody.
Thank you. Yeah.